Hi there, welcome to kneppyinvests. Once a month I do a video on the current state of the markets. In these videos I go through the XJO, the Nasdaq and the S&P 500 just to see where each of those three markets have gone or traveled over the past month, and then determine whether I'm bearish, bullish or neutral on each three of those markets. And then what I do is I broaden my time frame. And I just want to look at where these markets have gone over the past 20 to 40 years. Yes, one of the charts I'll show you today is a 40-year monthly chart of one of these indices. And the reason I do that is I'm looking for certain signs or indications that the market might be coming to a correction. And I'm not trying to time a correction. What I'm doing is just looking at the increased chances, increased possibilities of a correction. And the main thing I am looking for is an exponential rise in any of these indices, because whenever you see an exponential rise in anything, it could be an index, it could be the share price of a company, it could be the price of lumber or beef. Whenever you see something rising exponentially, that's just increasing the chances there's going to be a correction in that asset in the future. And that's all I'm doing. Just becoming aware of the increasing chances of that correction. Now, I won't call it a bubble, because usually when on the upside of a bubble, that's when you do see that asset pricing rising exponentially. But I'm not going to call it bubble just yet. We also have to be aware that these runs in exponential, or these increases in an asset price that are going up exponentially, can run a fair while. So this correction or potential correction might happen next week, or it might happen a few years down the road. And I'm always of the belief that even though we can't perfectly time the tops and the bottoms of the markets or any assets, we can get near the top and we can get near the bottom. And if we're able to do that, we're much better prepared to protect our capital. And that's one of the most important things we have to do as an investors: protect our capital. The other thing I'm going to do in this video is have a look at some interesting news items that have been released over the past month that really made me think about where we are heading over the next 5 to 10 years. In fact, I think we're in one of the most interesting times right now, because the potential outcomes over the next 5 to 10 years is really broad. There's all these possibilities, and a lot of the possibilities where we're heading are not good outcomes. And it's all has to do with the policies that the governments and central banks around the world have done over the past 18 months to protect ourselves and the economies from COVID-19. And if you go through history, the vast majority of corrections, recessions, depressions have been caused by bad government and central bank policies. And that is a possibility in the future. All this money printing could lead to some bad things in 5 to 10 years. And there's lots going on right now in regards to wage inflation, energy prices going through the roof. I tried to buy petrol the other day and it's almost $2 a litre. So many things are happening, and I just don't think many economists around the world, even those in the highest paid jobs, know what's going to happen over the next 5 to 10 years. And again, I think it's very wise to be aware of all the possibilities, just so we can protect our capital if something bad does happen. First chart I want to show you is the XJO daily up until October 15, the time I did my previous video. And at this point in time, we had seen the XJO be under pressure for about a month and a half, but it looked like it was turning around, and it was very similar to what we saw in September and October of 2020. And once we got into November and December of 2020, we did see the market increase quite significantly, particularly in November last year. So because it looked fairly similar to what we've seen or comparing to September last year, I'd become a little bit less bearish and a little bit more bullish. Not quite a bull, but definitely in between being neutral and bullish, just because the last few days of trading up until October 15, we had seen the market pull out of a potential downtrend into a potential recovery, just like we saw 1 year ago. And if we look at the market, the XJO up until November 19, nothing much has happened over the past month. It has increased by about 30 points. But when you look at the overall daily chart right now, I'm getting more neutral vibes. I'm not bearish nor bullish when I'm looking at the chart. It looks like it just wants to go sideways, which is not a bad thing because it is very healthy for anything to consolidate or go sideways for a period of time, just to breathe. So at this point in time, I'm neither bullish nor bearish about the XJO or the Australian markets. I'm definitely neutral at this point in time. We're not surprised to see the markets go up from here or even down. And that's the whole definition of being neutral. As we turn our attention to the American markets, the S&P 500 daily is a little bit different than the Australian markets because even though we did go through that correction during September and October this year, the S&P 500 and the Nasdaq have responded or recovered really well. In fact, they're almost at all-time highs. So a little bit more bullish when it comes to the S&P 500 and the Nasdaq compared to Australian markets. And more than likely, the reason why the American markets are a little bit more bullish is probably because of tech stocks. A lot of tech stocks had a really good quarter results, beating expectations. And I think maybe that's why the American markets look a little bit more bullish than Australian markets right now. Now onto the weekly charts. And the first index I want to look at is the XJO, going back to the end of the GFC in 2009. And ever since the end of the GFC, the XJO has been in this channel going, or upward sloping channel. And I've just indicated here with stars where we've been at the top of the channel or the bottom of the channel. And we've reached the top of the channel 4 times and the bottom of the channel 4 times as well. And only once has the XJO gone above or below, appreciably below the channel. And that was during the COVID-19 financial panic. I've ignored that a period of time just because it was extenuating circumstances. And right now we are near the top of the channel. Now that doesn't mean the XJO will be correcting towards the bottom of the channel because we might just see it right towards the top of the channel for a period of time, might be a year or 2 years. We saw that way back in 2009 when the XJO actually hit the top of the channel 3 times in about a year and a half. So don't be surprised if we remain near the top of the channel for a long period of time, or don't be surprised if we move towards the bottom of the channel over the next few years. All these possibilities are at play when you look at this sort of chart. When I look at the XJO weekly, I'm not really concerned at all because it's been increasing at a very orderly rate, something you would expect. There's no exponential rise in the index over a period of time, but it's a little bit different when we look at the S&P 500 and the Nasdaq weekly. And I have included a trend line here from the end of the GFC. And the S&P 500 and the Nasdaq were both trading very orderly from about 2009 all the way to the COVID-19 financial panic. But from the end of the COVID-19 financial panic, we've just seen the S&P 500 and the Nasdaq grow exponentially. And there's a lot of reasons behind that. But it's not healthy because whenever you see something rising exponentially, it just increases the chance of a major correction in the future. So I'm not really concerned when I look at the XJO weekly, but when I look at the S&P 500 weekly and the Nasdaq weekly, I am becoming a little bit more concerned and a little bit more aware of the possibility of a correction and a serious correction of that in the future. Doesn't mean it will happen anytime soon, but it just increases the chances it will. Just realized I haven't shown a Nasdaq chart yet. Have to correct that in the next slide. But as we turn our attention to looking at some monthly charts, the first focus is the XJO going back to 2002. And the most interesting about this, apart from a significant rise in the XJO from 2003 to 2008, just before the GFC, and interestingly enough, the low in 2003 was high or lower than the bottom of the GFC in 2009. Because we did see the XJO expand quite considerably over a 5-year period preceding the GFC. And during that period, we had 2 times when the XJO increased 10 months in a row in 2004 and then again in 2006. And that was a record for the XJO rising in a row. It equaled a 10-month period in 86, 87, which also preceded a major correction as well. And that record of 10 months in a row rising was recently broken because the XJO had risen for 11 months straight from October last year to August this year. And that record was broken in September, where we did see the market reach the top of the channel and then pull back by a significant amount. And then again in October, we saw the market decrease slightly. So far in November, the market is up by a little bit, but we still have a week and a half of trading. So we might see the November rising a little bit more, or it may be another 4. But a lot of times in the past, when you see a significant rise in the market over a period of many months, you will see on occasion the market just pull back, a healthy breather. Maybe that's what we've experienced in September, October this year, just a healthy breather, a little bit of a pullback before we see another significant rise in the XJO over the next 10 to 12 months. I have shown you the S&P 500 weekly chart, and it did look like that chart. There was a bit of an exponential rise since the end of the COVID-19 financial panic. But as we turn our attention to the NASDAQ Monthly, there's little doubt whatsoever that the NASDAQ has been growing exponentially over the past 5 years. In fact, I did draw a trend line, which is that upward sloping orange line from the bottom of the GFC, and the NASDAQ was traveling along that trend line up until 2015 or 16, and then ever since then it has been going up exponentially. You can't even see the COVID-19 financial panic here. It's just a little bit of a correction, not much at all, and it is NASDAQ is significantly higher than the top or pre-COVID levels. And this is a worrying sign, because whenever you see anything rising like this, there's without doubt little chance there won't be a correction in the future. And it does remind me of what happened during the tech bubble and then the burst. So let's have a look at that, comparing what happened in 1999 and 2000 to what's been happening right now. It is said that history doesn't repeat, but it does rhyme. And as we compare what happened with NASDAQ in 1999 towards the top of the tech bubble to what's happening now, there are some similarities there. Now, they're not identical because, again, that saying says history doesn't repeat, but it rhymes. It's not identical, but there's definite similarities here. One of the major differences is during the tech bubble, or just before the tech bubble, as we saw the NASDAQ go up exponentially, it just seems like the rate of increase really started to grow towards the top of that bubble. We really haven't seen that right now yet, but there's definite possibility in the future that if we do see a few months where the NASDAQ does grow significantly, that could be a sign that we're nearing the top. So that's something I am looking for, is a significant increase in the NASDAQ over a 1 month period. Final chart I want to show you in this video is the XJO Monthly over the past 40 years. So from 1981 to 2021. A few things I want to point out here, and I've also included an upward sloping trend line where you do expect the XJO to bounce off whenever it hits it. And it's done that 5 times in the past. It did it in 1990 when we went through a recession, also a few years later in 1993. It also did it during the tech bubble crash. It almost hit the trend line, but then bounced off it. It also hit it during the GFC and then bounced off it as it perfectly hit the trend line. And then during the COVID-19 financial panic, it almost got to the trend line. The XJO fell to 4,400, and at that point in time, the trend was around 4,300. So that trend line is a fairly strong trend line because it's hit it about 5 times in the past, and the XJO always bounces off it. The other thing you'll notice here, if you pay attention, is whenever you see the XJO rise exponentially, there's always bad things happen towards the end of that rise. It happened in 1987. We saw the XJO rise exponentially over a 2-year period preceding a major correction. We also saw it in 2008 and 9. We saw the XJO rise exponentially from 2003 all the way to the start of the GFC, and then it fell significantly over a year and 6-month period. Right now, we haven't really seen the XJO rise exponentially, but the distance between the trend line and where the XJO right now is, there is a large gap in between the two. So if we do see the exponential start to run up quite quickly, like we saw back in 19 85 to 87, and then in between 2003 and 8. If we do see that, that just increases the chance of a major correction in the future. And that is what I'm looking at when I look at the XJO Monthly right now. I'm just looking for potential signs of a major correction in the future. Now onto some of the interesting news items that have been going on in the past month. And the first one here is about wage inflation. The Reserve Bank of Australia wants a bit of wage inflation, and until they see any signs of wage inflation, then they won't increase interest rates. They've been talking about 2024 when they expect interest rates to increase. They've gone back on that recently, but there's a couple of articles written by Greg Jericho in The Guardian talking about no, wages are not about to explode. They are struggling to keep up with Australia's inflation, and Australia's wage crisis won't be solved until workers are adequately paid for their productivity. A couple of things I just want to mention here. The first thing is we are seeing inflation. Inflation is rising not only in Australia but around the world. I think it's about 3% right now in Australia. And if we don't see wages increase to keep up with inflation, our real wages will go backwards. And whenever you see real wages go backwards, people will tend not to spend. And that is a bad thing for the economy. So if we do see a period of inflation, even if it's transitory, and transitory just means prices won't continue to increase. But if we get 10% inflation and it is transitory, our real wages will still go down by a significant amount and spending will decrease. So it's very important, if we see inflation, that wages start to reflect that increase in prices. And the other really interesting thing was that we've seen increases in productivity, but we've not seen wage growth. And that's the exact opposite you want to see. You want to see people incentivized to become more productive. And if they don't get wage increases, wage rises, then there's no reason to increase their productivity. And this has been an issue, not only in Australia, but around the world over the past 40 to 50 years. We've seen significant increases in productivity, but not the same increases in wages. And that means more of that productivity is going to business owners, is going to the rich. And that discrepancy is something we need to correct in the future. And I think the way we're going to correct that is simply worker shortages. And that is going to be an issue over the next few decades. Just to emphasize one of Jericho's articles, this is from one of those articles that he did write, sourced from Australian Bureau of Statistics, looking at the rise in productivity compared to real wages rises over the past 17 years, and there has been a significant difference between the two. Now on to inflation, and we've been told by reserve banks and governments, or central banks and governments, that inflation is just transitory. It's just a one-off thing because of supply issues and all that. But there are people starting to question whether that is true or not. And this is an article written by Matthew Cranston, a US correspondent for the Australian Financial Review. And the title of this article was US Inflation Not Looking Quite So Transitory Now. And probably the most interesting thing in this article is found right at the end, where there is a quote from Joe Biden. And that quote is, "Many people remain unsettled about the economy, and we all know why. They see higher prices." He said that last week sometime. The scary thing is, however, is that very few people saw them coming, which is not quite true. I think there are some people who were concerned that inflation was not going to be transitory. And the question is, why are governments and central banks around the world trying to tell us it's going to be transitory? It all comes back to psychology and expectations about prices in the future. If we expect prices to be higher in the future, we are going to go to an employer and demand higher wages. And if the employer is paying us higher wages, they increase the prices they are selling their stuff for, and then just rinse and repeat. And that was one of the problems in the 1970s, is this expectations of inflation was there. People were just expecting it. And that's why inflation can be a problem, just because of our expectations. One thing you might have been noticed over the past few months is how petrol prices have been rising quite considerably. And I'm pretty sure This plays a part in CPI. A lot of other things play a part in CPI as well. But just the other day, I noticed that there was a petrol place near me. In fact, there's two petrol places near me, about 100, 200 meters apart. And one was charging $1.94 a litre, and the other one was charging $1.56. So if you do shop around, you can save yourself upwards of $20 every time you fill up, maybe even more if you have a large petrol tank. But right now, this is, I won't say a concerning thing for me, but during the 1970s, prices of petrol and oil played a significant part in inflation issues we did face in the 1970s. And that's what I want to talk about right now. Dan Eberhardt, the CEO of Kneppy, which is a privately owned oil field service company in the United States, might be one of the world's largest privately owned oil field service companies, wrote an article in Forbes titled Energy Crisis Threatens Return of 1970s Inflation. Now, I'm not an expert of the Great Inflation, which is what they call the inflation the world experienced during the 1970s. I do know the energy crisis, the price we're paying for petrol, did play a part, but I'd be hesitant to say that was the major part. I think there was some other issues at play, and that's why I decided to do a little bit more research just to see what caused 1970s inflation. Why do we see a period of time where inflation was over 10%? And I found this little article called The Great Inflation, written by Michael Bryan of the Federal Reserve Bank of Atlanta, and he sort of confirmed what I was thinking. This is a quote from this article. While economists debate the relative importance of the factors that motivated and perpetuated inflation for more than a decade, there is little debate about its source. The origins of the Great Inflation were policies that allowed for an excessive growth in the supply of money, Federal Reserve policies. I've already mentioned that the vast majority of recessions, depressions, of corrections in the market were caused by bad policies from governments and reserve banks. So it seems like there is potential. That's exactly what happened with the Great Inflation. It was just this excessive growth in supply of money. And I think there was this debate between full employment and inflation leading up to this Great Inflation period. I think they were really focused on full employment, and that affected inflation. And in the chart on the top right there, you can see inflation for a period of time was between 10 and 15% towards the end of the 1970s, start of 1980s. And this period of great inflation was eventually solved by, what was his name, Paul Volcker, who increased interest rates, set the American economy into recession, but those policies decreased the inflation perfectly. And this is a perfect quote from Fed Chairman Jerome Powell, who mentioned how important psychology is to the rate of inflation. If people believe that prices will be pretty stable, then they will be, because they won't ask for very high wage increases, and people who sell things won't be asking for high price increases. Once that psychology sets in, it tends to perpetuate itself. That's exactly what we saw in the 1970s. The expectations were we're going to see high prices in the future, so everyone was expecting their wages to increase, and they were expecting the prices they were going to pay for all their products to increase. And right now, or in the past, say past 10 years or so, expectations were inflation was not an issue. So we won't go in expecting higher wages, and employers won't be expecting to increase the price they're selling their products. But that could be shifting right now. There's definitely I won't say a fear, but awareness out there that inflation could become an issue. And that's why the banks, reserve banks, central banks, and the governments are trying to tell us inflation is just transitory. It's not going to be a problem. But if we don't believe that, then inflation more than likely will become a problem. If we do believe it, then more than likely inflation won't become a problem. Now on to one of the most interesting articles I did read over the past month, because this really opened my eyes up to how some people think is a way to combat inflation, and it's the complete wrong way to combat inflation. It's all about ending consumption. This is an article from the Wall Street Journal titled An Antidote to Inflation. Buy Nothing Groups Gain Popularity. These groups are having a moment, adding some 2 million participants in the past year as prices rise and concerns grow over waste. The most interesting thing about this is that consumption is one of the most important things we do to grow the economies. And if we stop consuming, then the economies around the world will simply collapse. And maybe this is what these groups are trying to do. Maybe they are wanting Armageddon, but this is definitely the wrong way to combat inflation. And just to emphasize that how important consumption is to economies around the world, this is the private consumption as a percentage of nominal GDP for Australia going back to 1960, so a 60-year period here. And private consumption usually is between 50 to 60% of GDP. In fact, in some countries, it's even higher. In the United States, it's right on 68.5%. And this should show us that consumption is really important. It should show us that just going out and spending some money is really healthy for the economy. And I've even heard some people say, I don't want to save money or too much money because that is actually harmful for the economy. This actually is true, but we have this sort of dilemma because we do want to save money, we want to invest, but investing more and more of our money and not spending it is actually harmful for the economy. So there is a balance we need to achieve between spending and saving or investing. And I think it's an individual choice. So don't feel guilty if you are spending money because you are helping the economy, but also don't feel guilty for saving or investing because you are giving yourself a better chance of a more enjoyable future. That is all I have for this video of the state of the markets. If you have any questions, if you disagree or agree with me, and you'd like to put forward your opinion, I'd love to hear it, because just because I have an opinion doesn't mean it is right, and you do have the chance to persuade me to change my opinion, because if you can't change your opinion on anything, then that's a really sad way to go through life. Anyway, so leave a comment, your thoughts, a question in the comment section of this video. And otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.